Hi, welcome back to Wesbury 101. I'm Brian Wesbury, Chief Economist at First Trust Portfolios. Remember, we want to be the antidote to conventional wisdom. Well, this week we have tons to talk about, but let me go back a little bit and back to September of last year when Hank Paulson and the Bush Treasury proposed the TARP plan, the Troubled Asset Relief Plan, and they were going to use $700 billion, if you remember, to buy toxic assets off of bank balance sheets and therefore help heal the system. Well, before this thing ever even got off the ground, it became apparent that they weren't going to be able to buy these assets because they couldn't price them. So what they ended up doing was injecting bank money into banks and literally taking over big parts of large U.S. banking the system and forcing these banks to take this money, which then turned into a problem. And now lots of these banks want to pay back their TARP money, but the government won't let them, in a sense. But they want to pay it back because they're scared to be partners with the government. The government's firing CEOs, taxing bonuses, or trying to, all kinds of changing the rules after the laws have been signed. It's a real toxic problem for many banks in the system. In fact, one of the reasons these toxic assets are not getting taken off of bank balance sheets is because the government has become very toxic, and no one literally wants to play. In fact, you can see that in the TALF, the Term Asset-Backed Lending Facility that the Fed is trying to get going. The first month was $4.7 billion. The second month fell. They were hoping it would grow to only $1.7 billion. It looks like people just don't want to play ball with the government. We're also hearing this about the PPIP, the public-private partnership that the Treasury, Tim Geithner, the Treasury Secretary, is trying to put into place, and that many people are balking at being a part of that or selling assets into that, once again, because the government has made itself more toxic, if you will, than the toxic assets that these banks are forced to hold. Now, there's some good news, and that is the mark-to-market accounting changes that were put into place by FASB on April 2nd they weren't perfect. I'm going to call them good but not perfect. I really want a suspension of mark-to-market accounting. We operated for 70 years without it, and everything was just fine. Not perfect, but we didn't have panics or depressions. And yet today what FASB has done and made some good changes. And what I would argue is that these changes, and I won't go into specifics because there's lots of our accounting arcana, but what these changes do is they will stop the erosion in bank capital just from being forced to mark to distressed or fire sale or illiquid prices. And that is very good news. Now, I also expect some write-ups by banks, but that may not show up until the second quarter. But the key thing here is that we are likely to see the decline in the erosion of capital positions because of mark-to-market accounting. And this, I think, is very good news. In fact, this is the best news that we could hope for, because the best place to keep these toxic assets, believe it or not, is on the balance sheets of the banks that bought the loans or made the loans in the first place, because they're the ones that are going to have the most incentive to work those loans out. They're also the ones that are going to have the most incentive to gain as these assets gain in value as the economy improves. And that's the last point I want to get to. And that is that the mark-to-market accounting changes, I believe, will really put the floor here in the stock market because they run the shorts away. But the second thing is that the Federal Reserve has been super easy. We've talked about this before. But if you look at M1, the money supply that includes checking accounts and currency, it's up 25% in the past 6 months at an annual rate. Currency is up almost 16%. Demand deposits, these are checking accounts at banks, in the last 6 months are up 74% at an annual rate. If you look at any of these numbers in kind of a context of history, it looks to me like the Federal Reserve is easier than it's been at any time in its 96-year history. And remember, they still have another $1 trillion that they want to put into the banking system by buying treasuries and buying mortgages, and they're just getting started on that program right now. What this means is, despite the toxic government, and the fact that these toxic asset relief programs are not getting off the ground, the economy is recovering anyway. Mark-to-market accounting and easy money are doing it. The stock market is up significantly. The economy seems to have turned the corner. I think we're going to be surprised by corporate earnings on many fronts in the next 6 months. The market, in my opinion, has hit a bottom. This is not a dead cat bounce, and in fact, we could go a long way from here. Remember, in 1975 and 76, in the middle of a horrible economic time, this S&P 500 gained almost 60%. I think it was 57% from bottom to top. And I think we could do the same here in the next 12 to 16 months. Once again, thanks for coming to Wesbury 101. Remember, we want to be the